Hello everyone and welcome back to another video. In today's video, we are going to be continuing our Intelligent Investor series, and we are going to be covering Chapter 2. Now, Chapter 2 I think is very relevant right now because this chapter is all about inflation. And, well, inflation in the United States is currently sitting at a 40-year high. So this video is basically going to be on what the Intelligent Investor says about inflation and how investors can protect themselves from inflation. Now, very quickly, if you're just tuning into the channel or into this series, this is a series that I am doing going chapter by chapter through the entire Intelligent Investor. So if you want to follow along or stick around, then make sure you subscribe to the channel and also hit that little bell icon, because then you will actually get notified when I make these Intelligent Investor videos. YouTube really does not like promoting this type of content, which I think is really unfortunate, and these videos typically do not do well on my channel, and again, YouTube will probably not notify anyone that I'm even making this video because they really just don't push this type of content. So make sure you subscribe and make sure you hit that bell notification if you want to stay up to date with this series. And with that being said, let's now hop into the computer and let's get started going through Chapter 2 of The Intelligent Investor. All right, so let's just hop right into it. And the first page that we got to talk about is page 47. And this is actually the first page of Chapter 2. So right here it says, inflation and the fight against it has been very much in the public's mind in recent years. The shrinkage in purchasing power of the dollar in the past, and particularly the fear or hope by speculators of a serious further decline in the future, has greatly influenced the thinking of Wall Street. It is clear that those with a fixed dollar income will suffer when the cost of living advances, and the same applies to a fixed amount of dollar principal. Holders of stocks, on the other hand, have the possibility that a loss of the dollar's purchasing power may be offset by advances in their dividends and the prices of their shares. So there's a couple of takeaways from this first page of Chapter 2 here. And the first one is that anyone with a fixed dollar income is going to suffer the most when inflation occurs. This is because people with a fixed dollar income, they're not seeing any raises, but the cost of living is going up. So the amount of money that they're spending just for basic necessities like housing, fuel, rent, groceries, etc., those prices are going up, which means that they're eating more of these people's income, which essentially means that these people are not going to have as much disposable income after they pay for all of their necessities. So really, anyone who is making a fixed income or a salary that is not going up with whatever inflation is doing, those people are going to be hurt the most from inflation. And they're going to find that they have less money to spend at the end of every month and less money to put towards their savings or their investing goals. Then the second point that this page is making is that the people who hold stocks or investors have a better chance at fighting inflation for two reasons. The first reason is because many companies in the stock market like to pay out dividends to their shareholders. And then what these dividend companies do is they raise the amount of dividends that they pay out to their shareholders when the business produces more earnings, more cash flow, and more revenue. This essentially means that people who hold dividend stocks will see their dividend income increase with inflation and potentially even beat what inflation is doing. We actually saw this a lot in the stock market over the past year, where inflation has been about 7%, and a lot of dividend paying companies have actually increased their dividend payments by over 7%. So essentially, these people with this dividend income, their dividend income is growing at a faster rate than what inflation is doing. So these dividend income investors, once again, are actually beating inflation if their dividend stocks pay out more dividends every single year and the rate of dividend increases is higher than what inflation is doing. Now, the second way that investors beat inflation is simply by the price of their shares actually going up over time. There is a lot of stocks out there where the price of their shares actually increases more rapidly than what inflation is doing. And there's actually some companies out there that benefit from inflation. There's some stocks out there that benefit from inflation. We are going to be talking about these specific stocks a little bit later on in this chapter, but just know that a lot of investors like to invest because they simply benefit from inflation and they can actually protect their wealth from inflation, rather than someone who does not invest and someone who just has a fixed income salary that does not go up with whatever inflation is doing. So that is what the first page of Chapter 2 is saying, and I really like that Chapter 2 starts out this way because it's clearly saying that investors are essentially beating inflation, and people who are not investing have a really hard time benefiting from inflation or beating inflation. So investors are essentially protecting their wealth and they can actually benefit from inflation, which is a major reason why I think pretty much everyone should be investing. So now let's move on to page 52, and the highlighted part here says, the only way that inflation can add to common stock values is by raising the rate of earnings on capital investment. On the basis of past record, this has not been the case. So what this first passage is saying right here is that for a stock to actually benefit from inflation, its return on invested capital has to actually go up, or essentially its ROIC has to go up. This is a metric that a lot of investors like to pay attention to because return on invested capital tells investors how much the company is producing on the capital that it actually invests into growth and just growing the business for shareholders. And again, the intelligent investor is very clearly saying right here that a stock will only benefit if inflation somehow benefits a company's ROIC metric. And it's also saying that throughout history, this has not been the case, which ultimately means that historically, inflation actually hasn't benefited most stocks in the market. And we're going to see a little bit later on in this chapter that inflation does not necessarily mean that the stock market is going to continue going up or that stocks are going to produce returns. So this is a very important point right here. And now let's move on to the second highlighted passage where this says, in the economic cycles of the past, good business was accompanied by a rising price level and poor business by falling prices. Now, this is another very, very important point. And I've read The Intelligent Investor about 7 times now, like no joke. And I actually noticed this passage right here on my last read through when I was prepping this video. I never even noticed this sentence right here, but this is so key. So what this one sentence is saying right here is that good businesses can typically increase their prices with whatever inflation is doing. So like if inflation is 5%, then they can simply just boost the price of their products or their services up by 5% to combat inflation. Whereas poor businesses will see their prices go down or essentially just remain flat during inflationary times. So basically what this tells me as an investor is if I am noticing that during high inflation, there is a business that is able to continue increasing its prices, then that most likely is a good business. But during inflation, if there is a business where it has to decrease its prices to try and get more business, that is most likely actually a poor business. Now, what is also really interesting about this is Warren Buffett himself has actually said that one of the best things to own during high inflation is a strong brand. And the reason for this is because consumers resonate with strong brands. Like I always say, think about a Coke on my channel, like Coca-Cola. If someone is craving a Coke and someone wants to buy a Coca-Cola, they are specifically going to go and buy a Coca-Cola. They're not necessarily going to care so much about the price of that Coke. Like if Coke decided to raise their prices by 10% tomorrow, I can pretty much guarantee, or at least I think, that a lot of people would still be happy buying that Coke and they wouldn't care too much about an extra 30 cents or whatever. So in my opinion, Coke is one of the companies that is a great business because they have such a strong brand that they can continue raising their prices with whatever inflation is doing. So the main takeaway from this one sentence right here is during high inflationary times, it's really good to find businesses that can continue increasing their prices and increasing their revenue to match whatever inflation is doing. And typically this will be companies with incredibly strong brands. And these are also companies that are seen as good businesses. So that's a really good takeaway from the intelligent investor right there. All right, but now let's move on to page 54. And this page says, the stock market has considered that the public utility enterprises have been a chief victim of inflation, being caught between a great advance in the cost of borrowed money and the difficulty of raising the rates charged under the regulatory process. But this may be the place to remark that the very fact that the unit cost of electricity, gas, and telephone services have advanced so much less than the general price index puts these companies in a strong strategic position for the future. They are entitled by law to charge rates sufficient for an adequate return on their invested capital. And this will probably protect their shareholders in the future as it has in the inflations of the past. Now, this is a really interesting paragraph to me because there is kind of this ideology out there that utility companies are actually bad businesses to own during higher inflationary times. This is simply because utility companies typically have a lot of costs associated with their businesses, and they're also typically companies that take on a lot of debt. And when inflation rises, typically interest rates go up to try and slow down inflation, which means that all of this debt that these utility companies have becomes a problem, and they got to start paying more interest on that debt, eats up more profits, so utility companies do not benefit during inflation. However, the intelligent investor then combats this argument by saying they are entitled by law to charge rates sufficient for an adequate return on their invested capital. This basically means that utility companies by law are allowed to be profitable and raise their rates or whatever with whatever inflation is doing. And here on my channel, this is actually what I have been saying for some time. There's actually one company in specific called Brookfield Infrastructure, and about 70% of this company's revenue is indexed to inflation. So what this means is that in their contracts, it literally says that they can increase their revenues and their cash flows to match whatever inflation is doing. So this utility company in specific actually benefits from inflation, and it's become one of the largest positions in my portfolio. And it's a stock that I talk about here on my channel because when we're seeing 40-year high inflation, this company's fundamentals, its revenues, and its cash flows are growing incredibly well. And this company is actually benefiting again from inflation. So in my opinion, there are utility companies out there that can actually benefit from inflation, and utility companies are not victims of inflation. And I just found it kind of interesting to see that the intelligent investor is also backing this up. And this is something that I have already seen in my own personal portfolio. So utility companies can actually be hedges against inflation. Essentially, that's what this page is saying. All right, but now let's move on to page 55. And this page actually talks about gold as a hedge against inflation. And I found this very interesting. So this page says, alternative to common stocks as inflation hedges. The standard policy of people all over the world who mistrust their currency has been to buy and hold gold. This has been against the law for American citizens since 1935, luckily for them. In the past 35 years, the price of gold in the open market has advanced from $35 per ounce to $48 an ounce in early 1972, a rise of only 35%. But during all of this time, the holder of gold has received no income return on his capital and instead has incurred some annual expense for storage. Obviously, he would have done much better with his money at interest in a savings bank in spite in the rise in the general price level. So essentially what this paragraph right here is saying is that from 1935 to 1972, the price of gold only went up from $35 an ounce to $48 an ounce. And I did the calculation over here, and that is a 0.86% compounded annual growth rate. So that's a compounded annual growth rate of not even 1% over 35 years. Now, I'm just going to say that this is an absolutely awful compounded annual growth rate for 32 years for just holding gold, which ultimately means that right here, the intelligent investor is saying that over this time period, gold did not serve its purpose at being an inflation hedge. And it's basically saying that, you actually would have done better just holding your money in a high interest savings account during this time rather than owning gold. You actually would have produced more returns just holding cash and having that cash produce interest in a savings account. So basically there's actually been periods in history where gold is not actually an effective inflation hedge, opposed to contrary popular belief in the stock market. I thought that this was very interesting when I first read it. So now let's move on to page 60. And there are two really important points right here that I want to talk about. And one of these may actually shock you, but the first one says, since 1960, 69% of the world's market-oriented countries have suffered at least 1 year in which inflation ran at an annualized rate of 25% or more. On average, those inflationary periods destroyed 53% of an investor's purchasing power. We would be crazy not to hope that America is somehow exempt from such a disaster, but we would be even crazier to conclude that it can never happen here. All right, so basically what this first point right here is saying is that basically 70% of capitalist economies around the world and capitalist countries have had at least 1 year where inflation was more than 25%. Or in other words, the majority of capitalist economies have had years where inflation was more than 25%. That is a lot of countries, okay? And that is a very high rate of inflation. Then it also says we would be crazy to conclude that this can never happen in America. So basically, we would be crazy to think that 25% inflation could never happen in America. And actually, during the 1960s, I believe that inflation was around 15% in America. So America has had periods of really high inflation in the past. And basically, the book is saying that we would be crazy to think that this could not happen again in America. Now, the second point here says rising prices allow Uncle Sam to pay off his debts with dollars that have been cheapened by inflation. Completely eradicating inflation runs against the economic self-interest of any government that regularly borrows money. Now, this point is incredibly interesting because it's essentially saying that inflation is actually in the government's best interest, especially in governments that borrow a lot of money. Because if inflation is higher, then the amount of borrowed money that they have essentially becomes devalued. And the higher inflation is, the more devalued their current debts become. Now, I also thought that this was really interesting because the US is taking on record amounts of debt right now. Like the US debt is getting insane. So it also is kind of funny, that higher inflation is happening at the same time that the US is taking on record amounts of debt, and that, high inflation actually benefits countries when they're taking on more amounts of debt. So it could actually be in the US government's best interest for inflation to remain high while they are taking on debt, so that their debt becomes devalued and that they can actually manage it better in the future. So I thought that this was incredibly interesting, and I think that it's just important for investors to know that sometimes inflation is actually in the government's best interest, despite what they're saying. So just think about that. All right, moving on to page 61. This says, the historical evidence is clear. Since the advent of accurate stock market data in 1926, there have been 64 5-year periods, 1926 to 1930, 1927 to 1931, 1928 to 1932, and so on through 1998 to 2002. In 50 of those 65-year periods, or 78% of the time, stocks outpaced inflation. That's impressive, but imperfect. It means that stocks failed to keep up with inflation about 1/5 of the time, or about 22% of the time. So basically what this paragraph right here is saying is that the majority of the time, stocks do a really good job at hedging and protecting investors from inflation. But about 22% of the time, or 1/5 of the time, stocks actually do not outperform inflation. So there should be about 1 in every 5 years where stocks do not perform better than inflation. And we as investors should expect that. We should be prepared for it. And we should just not get upset sometimes when inflation is higher than stock returns. This has happened multiple times in the past, and it will happen again in the future. So if we see inflation at like 10% this year and the stock market goes up like 3%, we're probably going to hear a lot of people panicking saying, inflation, oh my God, it's worse than stock returns. Everyone, like, this is awful. But the reality is that has happened before in the past. It's going to happen again and again and again in the future, and we're going to get through it. Everything's going to be fine. There's going to be times where inflation is higher. It's happened in the past. Again, we've gotten through it. The economy's moved on. The world has progressed. Technology advanced. And that's basically just the cycle that we're going to live through. We're probably going to see it multiple times throughout my lifetime, maybe your lifetime. And yeah, it is what it is. As an investor, just got to suck it up. That's what's going to happen. So high inflation is going to come, and we just got to deal with it. Now, this next page is page 62, and it basically is just a chart of how well stocks do against inflation. Now, these little black bars right here are inflation, and then the white bars are the return on stocks. Now, on the left-hand side of the chart, we can actually see that this was during deflation, or when inflation was negative. And we can see that for the most part, when there is deflation, stocks produce negative returns. And then when deflation starts to subside, stocks produce better returns. And then when inflation is moderate, typically stocks actually produce positive returns. I mean, if we take a look, there's much more positive years on stocks than negative years on stocks when inflation is in this moderate range. Then what's interesting is that when inflation starts running really hot right here from about 6 to above 10%, then stock market returns start to become very volatile. They can be negative, they can be great, or they can be very negative. So when inflation is higher, basically stocks become more unpredictable and they can swing much more rapidly. They can have very bad years or they can have very good years. So just taking a high level view at this chart once again, when inflation is moderate, typically stocks perform better, they're much more stable, and they produce decent returns. And then when inflation runs really hot, stocks become much more volatile and returns go all over the place. If we're ever in a high inflation environment again, where inflation is like 7 to 10%, we're actually in that right now, we can basically just expect stocks to be quite volatile and returns to be all over the place. All right, and now let's move on to page 63. And I have some highlighted parts in this, and this says, since Graham last wrote, 2 inflation fighters have become widely available to investors. Real estate investment trusts, or REITs, pronounced REITs, are companies that own and collect rent from commercial and residential properties. Bundled into real estate mutual funds, REITs do a decent job of combating inflation. While a REIT fund is unlikely to be a foolproof inflation fighter, in the long run, it should give you some defense against the erosion of purchasing power without hampering your overall returns. Now, this right here was interesting to me because real estate historically has actually been one of the best assets to own to hedge against inflation and to fight inflation. And over the past couple of years, real estate prices have just gone absolutely crazy. I don't know if you guys are in the real estate market at all or paying attention to real estate prices, but real estate prices across North America and across the world have just been spiking, like going absolutely insane. So real estate is one of the asset classes that definitely benefits from inflation. And if we head over to Stock Unlock, I actually have this stock right here. This is an industrial REIT or another real estate company. And we can see that over the past couple of years, this stock has just been running like crazy. Again, this is a REIT in the stock market. And over the past 2 years, we have had that 40-year high inflation. So it does look like REITs, especially this REIT, has actually benefited from higher inflation. And again, real estate in general should benefit from higher inflation. So if we ever see high inflationary times, REITs can actually be a good way to hedge against inflation. And this is actually the last page of chapter 2 of The Intelligent Investor. So that's basically what the intelligent investor has to say on inflation. It's actually a relatively short chapter in the book, and there's not as many golden nuggets sprinkled throughout this chapter. So I think that this is going to be a shorter chapter. And yeah, so that's basically going to wrap up the pages and the highlights that I wanted to point out from chapter 2 of The Intelligent Investor on inflation. All right, everyone, and that is pretty much going to wrap up the video. And if you enjoyed this video or you found it helpful in some way, then please remember to leave a like on it. Especially remember to leave a like on this video because then it will actually get pushed to a wider audience and it will get more views. And YouTube will just push this video out to more people. And yeah, it would be awesome. Also, again, if you want to stay up to date with this series and get notified when I post in the future, then make sure you hit that little bell icon beside the subscribe button so you can actually stay up to date. And let me know what you all think about this series. Are you guys still enjoying it? Do you want me to continue doing it? And what did you think about this video in particular? Let me know down in the comment section below. I always love reading what you guys have to say. And with that being said, that is going to wrap up the video, everyone. So thank you all again so much for watching. I truly do appreciate it. I really hope that you guys enjoy this series because honestly, The Intelligent Investor is like the best book on investing ever written. And I really hope that you all are learning something new and gaining some new insights and value from going through the book, essentially. So again, thank you all so much for watching. I truly do appreciate it. And I really hope to see you all again in my next video.